Just wanted to make sure you know that you're not displaying yet.
I know I'm not yet. I'm setting up. Thanks. So, and if you have questions, please let me know as we go along. But let's see.
So Alan, if you do see me yawning, it's not you. It's 3 p.m. on a Friday. Don't take it personally.
Understood. But thanks for the disclaimer, but it might be because I'm boring you. I can't see. Now I can see more people. Okay. Okay, I think we're ready to get rolling. Happy Financial Fitness Friday. First, I would say, hey, why are we here today? Bottom line is that investment for retirement is confusing. And yet, sadly, we're not ever taught about it in school. And most of us aren't even taught about it at home as well. What are the best steps and options? So to me, this is important because pensions are basically gone. We're all ultimately replaceable, and securing one retirement now rests solely on our own shoulders. So at the end of this, hopefully, I'd like you to be able to, one, understand the main accounts and options available to you, and to be confident to start taking steps, if you haven't already, now to secure your own retirement with the ultimate goal that you can do what you want, when you want, with who and how you want. That's ultimately the desire. Disclaimer, as I've mentioned in the notes, this is not sanctioned by Viasat. This is educational. This is not advice. So speak with a professional for actual recommendations. But hopefully you find this useful, and this is a discussion. So please let me know if you have questions as we go along. We did a talk last month, and there seemed to be a number of questions. So focusing today really on these topics, just making sure people understand the different accounts and vehicles available to them. And then we'll get into a little more past 101 level on some of the stuff also. Okay, so these are your main vehicles, and none of them are exclusive. You can contribute to all of these, and you should contribute to all of these. I consider these are things that I made up myself, but the 401k is your dump truck for retirement. You can load up so much money in there that's going to be your primary source of retirement funds. Your health savings account, that's something, if you're in a high deductible health plan, is the best tax advantage plan, and that's a fire truck because it's available right now if you need it. But with proper planning and prevention, you can invest this money, and it takes advantage of both traditional and Roth benefits, and is the best tax advantage vehicle in the world. IRA, individual retirement account, that's something that to me, it's the all-terrain vehicle. And I wrote that Roth makes it military grade because it really provides flexibility both on the distributions and the investments, and how you control your money for the whole length of your life. Brokerage account, and I put in there just the ESPP and RSUs because some people might not think they have a brokerage account already, but they do, just if you've been contributing to these as well. But that's a tow truck, in my opinion, because it pulls you to the age where these other qualified retirement accounts, like the 401k and IRA, they have age restrictions, but nothing on the brokerage account. And it's also used for like shorter long-term goals, I would say. I used my brokerage account for the down payment on the house, for example. And Social Security, I put, a lot of you are very young, and they're probably saying, this won't be around. I really don't think they will get rid of it, but I consider that the Honda Civic, and I cut it in about 2/3 because there'll probably be about 70, maybe 75% at least left, even though when they, you hear all the politics talking about it, even when that supposedly dries up in 2034, it's funded by current workers at 75%. So there's too many people that are dependent on Social Security for it just to go away, but I kind of chopped it down. But I put it as a Civic because it'll last forever, and it's your best long-term annuity in reality. And if you're close to retirement age already, they won't change it on you right now. So if you're in your, already in your kind of late 50s, I'd say you're completely safe with 100% of what you think right now. Any questions? Key, you can contribute and should contribute to all of these if possible. Okay, start with the 401k. This is your, like I said, this is your dump truck. Most people think there's a like $20,500. That's our current contributions we can do. Actually, it's up, the IRS allows up to $61,000 under this 401k umbrella. And for people that the year they turn 50, you get catch-up contributions of an additional $6,500 potentially. There is no income limits. That's the key thing. There seemed to be a confusion. In Viasat, you can contribute to Roth or traditional or both, any combination of, and it doesn't matter how much you make. The CEO, he can contribute all Roth if he wanted to, unlike IRAs where there are income limits. Here's a quick look at kind of the breakdown of contributions to your 401k. Like I said, we can contribute up to $20,500 this year by ourselves. That's a maximum amount that you can contribute from your salary, but there's also the employer match. I put the maximum match basically down. I mean, you'd have to have a salary of $205,000 to get that, because then 10% of that would be the max, and then the 5% match would come out to $10,000. But you can see there's already potential for almost $31,000 there. That leaves an additional $31,000 that is potential for contributions. I wrote down a couple of things. Non-elective contributions, that's in our Viasat plan. And that would be probably like, and maybe we get that down the road with Viasat 3 and et cetera, but that's kind of like profit sharing. That's available, additional thing that they're not matching our contribution, but they just give us some money. So hopefully that happens down the road. A lot of plans, ours unfortunately allow for after-tax contributions. So you could just take after-tax money and keep shoving it into that 401k and investing it. Really cool plans, which I've tried to talk to Viasat about, allow for that and what's called in-service distributions, where you can take that after-tax money and then roll it into a Roth IRA, and voila, that's the mega backdoor Roth. And Congress is trying to get rid of that, and I hope they don't, but we'll see. Fortunately, it's an election year, so I think we're safe at least for this year. But and a separate thing, if you're an entrepreneur or have a side business on the side, you could open like a solo 401k. And even though you've already contributed your $20,500, you can't contribute more salary to that, but you could take up to like 25% of your profits and just shove that right into that 401k. So pretty cool. But that's, as you can see, it's a lot. Yep.
Oh, sorry, I didn't mean to interrupt. I just had a question about how do we know when it's best to, if we're investing for our 401k, like how much should we elect for Roth versus not Roth?
We'll get into that, and that's kind of a that's tough. It depends on the tax bracket and what you think taxes are going to do later. And we'll get into that further down the road, because we're still in the Tax Cuts and Jobs Act, where taxes are currently lower than they will be in 2026 or probably sooner. And so that might change your idea of how much Roth you want to contribute. But if it's going to if by taking Roth, it's going to bump you, say, from the 24 to the 32% tax bracket, that's probably not wise. I'd probably use traditional for a certain amount, so you don't get that additional money taxed at that higher bracket. But I got the tax brackets down, and we'll get more into that. Also, when people are young and their salaries aren't as high as late, you expect your salaries to go up over time, hopefully. Contribute Roth early, because your tax bracket's not very high, and later on your tax bracket will be higher, so you'll probably want to do more traditional, but you want a definite amount. Nobody, you'll see later, but nobody complains about having too much tax-free money in retirement. I know that didn't quite answer your question, but Nicole, I think we'll talk a little bit more about it. I think it'll make sense of kind of how to look at what fraction, you should do Roth and traditional.
Okay, thanks, Alan. Sorry.
No, don't. You're not. No, don't. If you have a question, please ask. And if we're about to get into it, I might just hold off. But please keep the questions coming. Okay. So, who doesn't like seeing free money, finding free money? Has anybody seen that? Like you walk down, find it 20, or you have an old jacket you haven't worn or some pants, and you're like, whoa, I got cash. Do you throw that away? No. Okay. I've heard people say they can't contribute at least 10%. So let's do an example of a salary of 100 grand. Let's see. Okay, that's if you only contribute 8%. That's what $1,000 looks like. A lot more than that 20 sitting there, right? But you just threw that away. Oh, you can only contribute 6%. That's 2,000. 4%. If you can't contribute 10% to the 401k, you got to really look at your finances and figure it out. This is free money and thousands of dollars you're just throwing away. So I figured a visual might help, since that this question came up last week or last time we talked about this, about should I suspend my 401k to save for a house down payment? And I was pretty adamant that no, because it's too much free money. Find other ways to save for it. Well, I did follow up later. What I did think about though is if you're in that kind of situation and you're looking to buy a house, then I would, like Nicole, this goes back to this, I would probably go traditional on the 401k. Then you're still getting that max match, but your paycheck's going to be larger because it's tax free, it's tax deferred. And then you have a larger paycheck, which so long as you use that savings to go put down for a house, then it's a win. But otherwise, don't do that. Does that make sense? Okay.
Hey, Alan, I have a question on that. So
Yep.
I had heard that you can use contributions to a Roth for a down payment for a home. Is that true? And if so, can you do that out of a 401k Roth or just personal Roth?
You can do that. I wouldn't do that. Okay. Roth is the tax-free growth. This is retirement money. Use other money to save for the house. Okay. That's kind of my thinking. Look at the bumper on this slide right now. And that kind of explains it well. This is retirement savings, not, that's what your brokerage account, et cetera, that you can use for the saving for a house down payment. But yes, you can pull out all contributions on a Roth IRA. You can also, I believe, I need to look at that, Luke. I think you can pull out your contributions on the Roth 401k as well. But I need to verify that. I don't want to give you bad information. But the Roth is sacred. Like, to me, it's not for a house down payment. You save money elsewhere. And I'd say the brokerage account for that, and let that tax-free growth compound and compound year after year, and just set your future up for nicely. Make sense? Okay. This also came up when that question came up about deferring money for the to save for a 401k. Somebody put in the chat, I didn't see it until later, but saying, hey, you could take a loan on your 401k. Don't do that. As well. This is, like I said, this is your retirement. But this is the beauty of a 401k and your IRA. Usually it depends on the state, but I think up to $1 million on the IRA. But the creditors can't touch it. You could have $5 million in your IRA, in your 401k, and then file for bankruptcy, and they can't touch it. So you're still a multi-millionaire. But that's what this ERISA, this Employment Retirement Income Protection Act of 74 has provided for us. So to throw that away is just terrible.
Hey, Alan.
So yes,
you keep mentioning don't touch it because it's your retirement, but what if part of the plan of stopping retirement fund contributions to get into a home earlier is because you consider that investment of a home part of your retirement plan?
I get that. So what I would do then is I would split your 401k. You've got money going into the 401k in your IRA. So then use your brokerage account. That's for your shorter long-term savings. Makes sense? That's to me where I would put my money. That's what I did. That's where I got my house down payment from. I had that in equities. And then I eventually over a couple of years, I cashed out some so that I had the money for the down payment and bought the home. To me, that's a better plan than potentially taking penalties on money or taking a loan. So if you take a loan on your 401k and it's pre-tax money, guess what you're paying that back with? After-tax money.
But you're paying it back to yourself.
No, you're paying it back to yourself. But get this, you're losing the growth already, but you're paying it back to yourself. But you're using after-tax money. So say it was pre-tax, you're paying that pre-tax money with after-tax money, only to then get it double taxed later when you pull it out for income. What a waste.
Right. I guess.
You know what I'm saying? Like you're double taxed on all that money, and you're losing out the growth.
Yes,
so,
but I think that's not counting the equity and appreciation that you're getting out of the leveraged house as well. That could outpace that entirely. The losses on that 401k, right?
Okay, yeah, I agree that that's a real estate question, and real estate is a great way to invest for your retirement as well. We can talk about that more later, but it's still, to me, it still doesn't change the fact that you can you could take a personal loan as well as not taking a loan on your 401k. There's other ways to get that money, or you take a small amount of your brokerage account and use that, because a house mortgage, even paying 20%, you're still leveraged 80% of it.
Mm-hmm.
So you're still getting that leveraged growth regardless, but you're not also destroying your 401k. Makes that makes sense?
Yeah.
I mean, this is you're asking
It's
good
in the
hard
weeds.
questions.
Okay,
What's
no,
that?
it's fine. It gets in the weeds. You have to really dig into it, and I understand. It's more like real estate facing, so I get it.
And we could have a different discussion on real estate specifically, because that's, I mean, you get 4 rentals and you pretty much set up, multi-unit rentals. You've set up your retirement forever. But anyway, but I did note though, and Kevin, you might not agree with this now, but I don't believe, if you at all possible, try not to, cash out your 401k or even take a loan on it, because I do provide some counseling though, if you. Okay, here's quickly the age-related rules with regards to the 401k. You'll pay a penalty if you take it out before 59.5 in general. And that includes doing Roth conversions. If you pay for the tax out of the conversion, that's nuanced, and we can go into that in more detail. But 10% penalty, what a waste. You can earn, if you are at the company when you turn 55, you can also you can start drawing on that money penalty free, and but you cannot roll it into an IRA. You got to keep that money in the 401k account. So if you're at 55 and Viasat, you decide to retire anytime from 55 years old onward, you can just start drawing on that money. Here's the problem though with drawing on. Ultimately, I think you'll want to roll that money, because when you take distributions on the Viasat 401k, it all comes out pro rata. The Roth portion, the traditional portion, all the equities, it's just it just all comes out. You don't get to pick and choose what you want to pull from, which to me is ridiculous. Like, you want to probably keep your Roth growing as long as you can. You want it, if the market's down, you don't want to sell off stocks at that point. It's so ultimately, it's a great option if you need that money at 55, but ideally, if you can use that tow truck, the brokerage and other means to get you to to 59 and a half, it's better you have better distribution capabilities out of an IRA, your Hummer. Required minimum distributions. These are ones that people young don't think about when they're shoving everything into tax deferred pre-tax, and then all they have is they can have these huge income tax bombs late in life. And then there's a whole bunch of rules on 5-year rules on Roth. But even with the Roth 401k, if you're 59 and a half and you just contributed your first dollar to your Roth 401k, you cannot pull out those earnings for another 5 years. So start that Roth at least $1, get it in there so that you start that clock. That's all you need is $1 to get that clock started. And RMDs, the only thing that doesn't require an RMD is the Roth IRA. That's why I said that's what really provides your flexibility long term in life. Okay, let's see. Here's a quick, give you guys a quick chance to look at this, but really an RMD is, they changed the age to 72 a year or so ago, but at age 72, government wants their tax deferred money back. So they want you to start paying taxes. And so and I said your 401k balance, say, was 3 million. But this is all your accounts that aren't a Roth IRA. Every traditional IRA, your Roth 401k, your Roth IRA, you take that total balance divided by your life expectancy, that when you're 72, it's currently 27.4. And that determines the minimum you have to pull out and get taxed on for that year. So if you've got more than that, it can go up. You combine that with Social Security and some other things, and you could suddenly be in a much higher tax bracket than you think. So we'll go into a little more about, hey, how do we manage these taxes long term? From now till eternity. Okay, so options. You leave the company. What do you do with your 401k? Most people probably know. Anybody want to say a few options? What we can do?
Roll it into a personal.
Oh, yeah, sorry.
Yep. No, that was good. Roll it into a personal IRA, right? You can roll it. You can keep it where it is, and that's that's what I did with my military TSB. It's so cheap. It's such low expenses that I just keep it there, and it's just basically broad-based index funds, which is nice. You can roll it into an IRA, or you can roll it into 401k. You can also withdraw it and pay penalties. Oh wait, okay, so that's not, in my opinion, an option. Don't withdraw it. Either keep it where it's at, or one of those first three options, because paying a 10% penalty on that money is just might as well just burn the dollars away. Note, if you do put it into an IRA, that will limit your ability to do a backdoor Roth, but I've got a slide specifically on that. Okay, health savings account. This is your best tax advantage account. Like I said, it's a fire truck. You could use that money now, but the best thing to do is just invest it, and then you keep track of all your receipts, and you can reimburse and pay for those right now out of your own checking account, and then you let this build up, and you can reimburse yourself. It's like the combination of the best of traditional and Roth. You get a tax deduction this year on that money, except for California state tax. I think California is one of the only 2 states that don't, but you still get the federal tax deduction. But then it grows tax deferred, and then if you pull it out for qualifying medical expenses, which is pretty much anything, you get that tax-free growth as well. So it's incredible. And then once you turn 65, if you don't want to use it for medical, you could still use it basically like a traditional IRA. You would have to pay taxes on the growth at that point, but most people, they expect there's going to be enough medical expenses to use it on. But this is great. It does require a high deductible health plan. And one thing, I said this the last time, what they have seen is people that are on this don't go to the doctor because they don't want to spend any money. Don't let this impact your health. Yeah, I think that's just ridiculous. What's all this money going to matter if you're dead? So take care of yourself, and you can. Here's the beauty thing. And Nicole, this is something I was thinking. You had a baby recently. Some years you can swap in and out of the high deductible plan. So maybe it's a more expensive year. You have a child, and there's a lot more expenses, and you're like, you know what? I'd rather have a PPO plan or something like that, where I'm not paying a whole bunch out of pocket. You can do that for a year and then switch back. You can go back and forth and take advantage of it. Don't feel like you're locked into it. But this is the best tax advantage vehicle there is. Unfortunately, retired military can't use it because we have TRICARE. I think I'd rather just have this. Any questions on this?
I have a couple. So on that note on the bottom, so you're saying that basically, like, if I spent $1,000 this year on medical expenses, but I paid out of pocket, like with my normal checking account, if I keep the receipts and everything for it, I could instead have that $1,000 growing in the HSA for 5 years and then just reimburse myself at that time. Is there a time limit
5 years?
on?
Nope, 5 years, 25 years, 50 years later, you can.
Wow.
When that thing's doubled 10 times, that 1,000 is now 20,000. You pay yourself back, and you've got an extra $19,000. Yeah,
Okay.
and all you have to do what you need to do is get organized. So get it, whether it's on Google Drive or something. You have medical expenses, reimbursable medical expenses, and just scan all those receipts. Whatever. Keep track of all of that, and then it's people have had no issues getting it. It works really well. So yes, that's exactly it.
Thank you. And switching back and forth from the PPO to the CDHP. So if I switch over to a PPO 1 year, it's not going to affect the growth of my HSA or my access to it. I just won't be able to contribute to it that year. But then when I switch back, I can go back to contributing to it again.
I think you could still, okay, I don't want you to take that money. I want you to keep it invested. I need to look up, but I think you can take that money at any point and pay for it. So if you're going to go on a PPO plan, here's the thing to do, in my opinion. There's an FSA as well, which is money, you can use for, that it has to be used that year, but that's also tax-free. So when you're on the PPO, set yourself up with a certain amount of FSA money that you're anticipating spending. And then you use that, so you're getting at least that tax advantage on the FSA money, and then go back and go back to the high deductible plan and start raking in that health savings account money.
Okay, thank you, and thanks, Ian, for forwarding this to me. This is great.
My pleasure.
Hey, Alan, sorry, to clarify what you guys were talking about with the HSA. So are you saying that if I have like you said, I had a baby last May, right? And I have a high deductible plan, so I paid like $4,000 to have the baby, right? So are you saying that I can like retroactively go back and pay out of my HSA, even if it's like next year or the following year? Oh,
next year, the following year,
that
50 years later.
Oh,
Sorry,
okay. I thought
cut you off, Nicole.
No, it's okay. I think I just always thought that like you needed to spend the HSA. Like if my bill came in today, I only have what's in my HSA today to spend it. I didn't realize that I could pay that bill from my checking account and then like wait till I had enough money in my HSA and then reimburse myself.
Exactly. And don't reimburse yourself. Pay it out of your checking account and let that money grow, not for a year, not for 10 years. Let it grow for as long as possible. Let that money compound, and then pay yourself back when you're retired. Like, I'll take this, all these receipts I've had for the last, 40 years. So yes.
Wow, thank you.
Go ahead. So that's what like I said, it's a fire truck. You can use it now if you need to, but the best thing is invest that and just let that money grow and grow and grow. But Nicole, what you can do, but I was saying, like, if you wanted to switch out to like a PPO temporary, for a year or so, then you would want your FSA money. That FSA money does have to be used that year or you lose it. So you really got to think about how much you got to be pretty smart there about figuring out how much money you think you're going to spend on medical, dental, et cetera, that year. But you can probably, figure that out pretty well. But that's FSA money that you have to spend that year. HSA money, let it grow forever and then reimburse yourself down the road. Okay, any other questions? Okay, now we're getting to the IRA, the individual retirement account. By the way, trivia, the IRS actually calls it an individual retirement arrangement. So if you're ever on the IRS website and it seems confusing, that's how they actually call it, but everybody else calls it an individual retirement account. Couple of things. It does, as you can see, it does take income, but if you say you have a non-working spouse, they can contribute to an IRA, a spousal IRA as well. So let's say the contribution limits are $6,000 per person, because these are individual, it's always per person. If you make at least $12,000, you can both contribute the full $6,000 to the IRA. So that's pretty cool, and that's something that far too many people don't take advantage of. Far too many people don't even open up an IRA, which is terrible. But this you have to open up separately, as we talked about last time. This is an account you open up at, my opinion, Vanguard, Schwab, Fidelity, or M1 Finance. That's a new cool one. Those are my favorites. They're the lowest cost and they have great options. But what the IRA does is really give you flexibility. Like I told you, the Viasat 401k, if you withdraw on it, you have no choice of where that money comes. It's just all thrown together and blah, here's your money. Part Roth, part traditional, part stocks, part bond, whatever. It's just how your sum of all your money is aggregated. It comes out fractionally like that. An IRA, you can pick okay, stocks have been doing well this year. I'm going to sell some stocks, take advantage of that gain. And oh, it's a down year. Nope, I'm going to hold these stocks and I'm just going to, sell some bonds or just use cash that I have. It just provides such an additional means of flexibility, and you can invest in whatever you want, unlike the limited options that are, typically available in a 401k. The beauty of the IRA as well, this is the same as the HSA. You can contribute up to tax day. So if you haven't contributed to 2021 IRA, if you don't have an IRA yet and you open up your IRA, you can contribute $12,000 right now, $6,000 for 2021 and $6,000 for 2022, and up until tax day this year for 2021. So that's good. That's good to know. A lot of people I know took advantage of that when COVID hit, and I know some people specifically at Viasat, it was great. They doubled up on 2019 to 2020, right when the market was tanking. Okay, like I said, Roth IRA, no RMDs. So you completely control when you want to pull that money. And you're not forced. And when you do pull the money, obviously there's no tax you're paying anyway. Okay, the bad thing about the IRA is our income limits. On the Roth, you see that up there. If you're single, you make, and these are phase out. So below 129K, you can contribute the max 6,000 or 7,000 if you're 50 and older. Up to, and it's kind of linear, up to 144K, you can no longer contribute to Roth. Even on the traditional, which is typically tax deductible, because we have a 401k plan, there's very little, but like pretty much most people are going to have to pay taxes on all that money. So why would you want to do that? Just go try to get into the Roth. And fortunately, there's still current ways to do that. And we'll go into the backdoor Roth, which the government's trying to get rid of. But I'm actually writing a letter to the congressman too about that. And I think you guys should as well. Any questions on income limits?
So on the traditional IRA, so that includes like the if you try to do pre-tax inside of your 401k, if you're over that income limit, then at the end of the year, you're actually going to owe back those taxes?
No. So the 401k, there's no income limits on at all.
Even
And
on
if
the
you could
traditional aspect of it?
on the traditional aspect,
Okay.
on the 401k, traditional and Roth, there's no income limits. It's tax deferred if you go, it's pre-tax, no taxes you pay on it. If you go traditional pre-tax, you pay taxes on it in Roth, but there's no limits. You can contribute 401k, Roth, traditional, or a combination, no matter how much you make. One thing it does though, Luke, is so if you contribute, and this is one of the tricks I'm going to show about how to potentially get into more money to contribute to a Roth, is you can contribute to your traditional IRA. Contribute to your traditional 401k, and that lowers your adjusted gross income and ultimately your modified adjusted gross income, which determines your Roth limits. That's your Roth income limits. And then you could, if that might lower you below that income limit, say below, if you're single, 129K, now you can contribute all your Roth money. And so that's a trick. And then there's another way, if you want more Roth, I'll show you in a minute. I verified it with the CPA. So here's the backdoor Roth. And this is like I said, Congress is trying to get rid of this. But what you do, so in general, with a traditional IRA, you need to have a traditional IRA and a Roth IRA. And pretty much everybody should have both of those, because you'll need it for Roth conversions later when you roll a traditional 401k to an IRA and then convert that to a Roth IRA. So you need both these accounts. I have a traditional IRA and a Roth IRA, and I have $0 in my traditional. Every year I take in January, I take money and the whole year's contributions, and I put it into my traditional IRA. That money settles, it takes about a day or two. And then with a couple of mouse clicks, I convert that to a Roth IRA. Wham, $7,000 in my Roth, then I invest it. I paid zero tax on that money. Well, it's already after tax, right? It's out of my checking account that I funded that. So I've already paid taxes, and it's non-deductible. So you don't, at the end of the tax year, say I contributed $7,000 to a traditional IRA, yada, 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 try to get $6,000. But you convert it to the Roth, and then you invest it, and then voila, tax-free growth for life. It's the key assumption though at the bumper, we'll get into that. If you had a 401k, or you have a lot of money in a traditional IRA that you've taken tax deductions on, you can get into trouble. It's not like I said, I'll pay zero taxes on that money that I converted that I backdoored from the traditional to the Roth, because I just put in cash, moved it immediately, and then invested it. So there was no gain on that money while it was sitting in the traditional IRA. But if you have money already in an IRA, there's something called the pro rata rule. And this you have to understand so that you don't pay more taxes than you expect. So some people, and I know Jim, he had this, he'd rolled a traditional 401k into an IRA, which is very common. But you do that, and none of that money has been taxed yet. Now you try that backdoor Roth trick, right? You contribute after-tax money into your traditional account. And this is what I have in the picture up here. So that big coffee cup, that's like you're sitting there pre-taxed IRA. It's $94,000. You put the cream in, which is the after-tax contribution you just made to the traditional IRA, right? You've already paid taxes on that money. It's out of your checking account. You put it together, put it in there, and then what happens? See to the right? Now you've got that new traditional IRA balance of 100K, but it's just like creamer in a coffee. It all gets mixed in, and now what is it? You've got 94% of that money is pre-tax, and only 6% is after tax. So you go and take that 6,000 and backdoor it into the Roth. The IRS is going to go, you haven't paid tax on 94% of that. Thank you very much, and you get taxed on that money. So how do you avoid this? Well, what you could do is roll roll your traditional IRA into the 401k, and our plan allows for that. And then your IRAs, and this is all IRAs, any traditional IRAs that you have, if you roll that into your 401k, then you have a zero balance on your pre-tax side, and the backdoor will work. Does that make sense? I know it's kind of confusing. Any questions there?
I do have another question.
It's confusing to me. The part that is confusing to me, that you are moving the money from 401k to your personal IRA, but I get lost when you move from personal IRA to the Roth IRA. That $6,000 that you invested was after the taxes. So how do you benefit it by transferring from personal IRA to Roth?
Okay, so Shama, let's go back and let's assume you don't have any money in the let's go with the benefit of a backdoor Roth IRA. You have no money in your traditional IRA. You contribute $6,000 of after-tax money to the traditional IRA. You're already over the income limit, likely to have that tax deductible, so it makes no sense to be in traditional IRA. Then you convert it to Roth IRA. You do that backdoor Roth conversion. Now that $6,000 grows tax-free growth forever. And you've already paid taxes on that money. You had no growth on it when it was in the traditional IRA. And so you don't pay any taxes on that $6,000. Now, if you say you had a large traditional IRA, whether that's just from years of contributing to a traditional IRA and taking the tax deduction from it, or you rolled a previous traditional 401k into a traditional IRA, now you've got all this money that hasn't been taxed yet by the government. So when you add that after-tax money, and then try to backdoor just that $6,000, the IRS sees that because it's like creamer in the coffee, it's all mixed together. All the aggregate traditional IRA, you will get taxed on 94% of that $6,000 as income tax. So the key is to do the backdoor Roth. You don't want any money or very little money in your traditional IRA that has not been taxed. Does that make sense?
Kind of. I will listen to your recording to get it.
And we can delve deeper. We can go over individual questions as well. I know some of these concepts are tough, and these are really the tricks. This is past 101 level. This is where it gets fun, I think. Okay.
This is the part I want to understand. This is the part really I want to get it. But go ahead.
Okay. Well, Shama, I'll make sure you understand it. Hey, this is one I was bringing up talking to you, and Luke, you kind of touched on this inadvertently, I think. Here's another way that you could, and this only helps if you're close to that, above that Roth IRA limit. If you're way over it, it doesn't matter because you can't contribute enough to the traditional 401k to bring your income, your MAGI, down below where you can contribute to Roth. But I was looking for options of, hey, they're trying to get rid of the backdoor Roth. How else can you still contribute to the Roth IRA? So if you say you had all your money, your income was 144K, you put 20,500 into the traditional IRA. Now your MAGI drops down to, what's that? 123,500, right? Now you're within the Roth limits for contributions. Now you don't need to do a backdoor Roth conversion. You just contribute to the Roth. And then if you had planned the whole time to keep that money as in that 401k as Roth, you could do an in-plan conversion of that money from traditional to Roth. You'll pay taxes on that money, but you'll have it now as Roth, but you were able to sneakily make it look like you have less income so that you can legally contribute to the Roth IRA. Does that make sense?
Alan,
Like I said,
could you repeat that one more time?
Yeah. Okay. So let's say, and I'm going to use the example of, because and this is just for a single person. The max, once you make $144,000 a year, you can no longer contribute to the Roth IRA, right? And that phases out from 129K to 144K. Well, if the back door goes away, we can't do that conversion. What you could do though is take all of your 401K contributions and make those all traditional. $20,500, that lowers your adjusted gross income for that year, $20,500. So now your Maggie is down to $123,500. Now you're within the limits of the Roth IRA to contribute. Now you just contribute your $6,000 to the Roth. And then if you wanted that money still as Roth that you just did traditional contributions, you can do an in-plan conversion of your 401k from traditional to Roth. That money is not included in your Maggie, in your adjusted gross income. You will pay taxes on that money, but it doesn't count in the money how the IRS sees what is your income limits for contributing to a Roth IRA. Does that make sense?
Yeah.
It's kind of confusing, but it's pretty cool. I actually had to ask the CPA. I asked him about this, and he's like, "No, you can't have your cake and eat it too." And I asked him, this is what we called in the submarine force forceful backup, or a questioning attitude. I didn't take his answer. I said, "Are you sure?" I think you can do this. And sure enough, he came back to me. He's like, "You're absolutely right." This is a good trick to use. So, but I'm glad I asked him twice. But that's anyway. Granted, if you make too much money, you can't. That won't work. But I was looking for an option when the Congress tries to shut off the back door. Any other questions there? Yeah.
I have a question. Can you go back a slide?
Yep.
That last option, in-plan conversion of pre-tax 401k, is that limited to the 6,000? Can you put more?
No, you could take, okay, Brian, let's say you've got in your 401k, let's say you've got 200 grand. You could, and it's all traditional. You could, all pre-tax, you could do an in-plan conversion for all of that money.
Just pay taxes.
Anytime. But you will pay taxes on it that year as income. So that's not a wise thing to do with that kind of money, but you could space it out. So in this, for instance, you contribute 20,500 to traditional, and then you convert 20,500 of traditional to Roth. Now you've got all that as Roth money, if that's what you desired.
It's tax-free forever, right?
What's that?
It's
Tax-free forever. Exactly. Yep. And I have a feeling Congress is eventually going to get rid of Roth. That's just what 15 years down the road. So I'm afraid of it. Hopefully not, but they're trying. Peter Thiel made $5 billion in PayPal, and now they're coming after all of us, trying to because he's now not paying taxes on $5 billion. Makes me
all
frustrated.
Of us and all the billionaires, huh?
Well,
I like throwing myself in the bucket with Peter Thiel. Yeah.
Well, no, like one billionaire, and now all of us, the rest of us, get screwed because they're mad at what one billionaire got away with, and that was only $1,700 he invested. Like, what, good on him. Okay, next. I'm not going to go into this in depth, but there's a lot of 5-year rules with the Roth. I can, but we won't have time. And it's confusing. That's probably its own little discussion. But the key is get your Roth, both your 401k Roth and your Roth IRA started. All you need is $1 and you start the 5-year clocks. There's multiple things. As I've said before, though, the Roth IRA can be used as an emergency fund. Contributions, not conversions, not backdoor stuff. Roth contributions can always be taken out immediately. You don't want to, Luke, like I said, You want that to grow tax-free, but it is an option that's available to you. Okay. Now we're on to the brokerage account, which I call the tow truck, because that's what pulls you to retirement age. And that's also where I recommend, Kevin, like for real estate, that's where I'd use some of that money. Or you can use, here's another thing, Kevin, instead of taking a loan on the 401k, you could take a loan, a pledged asset line of credit on your brokerage account and pay a very low interest rate and get that house. So it's kind of the same thing. You're just taking, but you're taking a loan on your brokerage account and you're not ruining your retirement account. But there's obviously the brokerage account, you've already got it since you have employee stock purchase plan and RSUs. I don't use E-Trade myself. I actually, when you sell that stock, it costs money. So many other places don't, doesn't cost the tax-free trading anymore. So I moved, there's a form I sent out to a few people. There's a form you can move your, Viasat stock from E-Trade to another account and then sell it from there and not pay anything. And it costs $0 for the transfer. So, but you do have to keep track of like the amount of money, because E-Trade doesn't give you all the cost basis and everything like that. But I've got a file that I created to where you can just easily look up in your E-Trade account.
When that happens, we do move money from the E-Trade brokerage account that Viasat sets up for you. Don't you have to report it to Viasat that you moved it and sell it, or just move it?
Yes, you do. And they'll actually come out. There's actually an email that comes out. They'll ask you about it. But yeah, you're supposed to, and probably that's really for people that are in certain lockout windows, that they can't use. But this is not limited to ESPP and RSUs. Like I said, this is where you invest a lot of other money, hopefully buy stock, buy equities, and then this is for your shorter long-term goals. And you just pay a lower tax rate, but you can take that money at any time. Any questions? Okay, here's a couple quick ways. How do you get money before you're 59 and a half, aside from obviously the brokerage account? The financial independence for retire early Roth conversion ladder. We'll talk about that. Like I said, retiring at 55 or later, and you can use that 401k. I don't like how the distributions come out of that, so I'm not a big fan of that. And then there's another thing called substantially equal periodic payments. I also don't recommend that, but people do that. You could set up basically annually taking a certain amount of money out for at least 5 years, or until you're 59 and a half, whichever is longer. And the problem with this though is you have to take out those equal, it's not flexible, and you have to take out those same amounts each year. And what if the market tanks? Then you're having to sell at an inopportune time when stocks are low. So this lack of flexibility, I don't like. That's why I personally like the brokerage account or doing the Roth conversion ladder. That's my choices for best way to get money out penalty free before 59 and a half. Okay, now we'll talk, Nicole, this will kind of get into the, I'm running out of time, about Roth versus traditional. One, tax rates are very low right now, relatively speaking. Do you think they're going to go up with our $30 trillion debt and all the money we've just pumped out in the economy? I'm guessing, so who knows, but I'm not. Having some Roth money is good, I guess, in general. But we'll get into a couple of those other things like IRMA, you guys probably aren't even thinking about or even know what the hell that means. But then there's another thing, if you're married and your spouse passes away later, suddenly you went from married tax brackets to single. And suddenly you could be in a huge, like a double, much higher tax bracket. Not something you want to think about, but it's something to consider. Okay, here's on the left, those are the 2022 tax brackets. On the right was what we're going back to. That's pre Tax Cuts and Job Acts. And I just circled a couple of numbers. It's married people, but look at the 24% tax bracket versus what the 33% tax bracket is on significant. So in 2026, we're definitely going back to these higher tax brackets at a minimum. So maybe, now might be a decent time to push up some of those Roth contributions for the next few years while tax rates are relatively low. Granted, California taxes sucks, but it's still, this might be a good opportunity. And Nicole, this is where you need to look at how much do you want to do. So you do not want to jump into, let's say, from the 24% tax bracket to the 32. So you want to look at how much your income is with you and your husband, anything else, rentals, income, all that stuff coming in, and you want to keep that below 340,000, because any money above that, you just, that money is taxed at an 8% higher rate of 32%. So you can look at what you have and then maximize this relatively low historical tax bracket of, say, 24% or 12%, whatever tax bracket you're in, and use that to pump up your Roth portions now before tax rates go up. And you're paying, one, you're making more money, and two, your tax rates are also higher for that same, even the money you have right now. Does that make sense? Did Nicole drop off, it looks like? Dang it.
No, my Zoom crashed, but my
okay,
audio is still here. Sorry. Yeah, I can't see the screen. I don't know what happened. But but what you're explaining makes sense. I just can't see the tax brackets. And then to clarify, did you say earlier that if we're contributing into our 401k, then that like adjusts our income? So is it our joint income after all of those contributions? Okay, so that's what I need to pay attention to.
Yeah, Nicole. So you and your husband could both contribute to all 20,500 to a traditional 401k. If you're assuming your husband has a similar, has a 401k plan, that would drop $41,000 off your adjustable gross income for the year. So that would lower your tax bracket. Say you were at 380,000, that would drop you down to 339,000 to get you within that 24% tax bracket.
Okay.
Makes sense. And then, but if you're not, so that's where, if you have more of a ceiling, but you still like that relatively low tax brackets right now, use some of that money to go Roth, pay the taxes on it at our historically low tax rates, before tax rates go up higher later. Makes sense. So maximize that window, say, of whichever tax bracket, whether it's the 12, the 22. So contribute Roth to keep, contribute traditional to keep you within that lower tax bracket, but then maximize the Roth within that tax bracket to take advantage of relatively historical low tax rates.
Okay, so the traditional contributions what lowers my tax bracket, and then after that would get me down so that, okay, so if we're like if we're above that that threshold where we can't have like a Roth IRA, for example, if we invest more in our traditional ahead of time, then it's going to bring down our tax bracket, and then we should be able to do Roth both for our 401k and for our IRA, right?
Hopefully. Hopefully you actually make too much and it won't work, because for married people, it really kind of sucks, in my opinion. I pulled it. I didn't realize you can't see it, but for married, the limit on Roth IRA contributions is only 214K. So if you guys,
what's the 214?
That's if you're married. That's your combined joint income. If it's greater than 214K, you cannot contribute to a Roth IRA.
Okay.
Right now, you can still backdoor, but if you made, if you're combined, you guys made 250,000, then you could both contribute all to the other trick I was saying, where you could contribute to the traditional, drop your adjusted gross income, contribute to the Roth, and then if you wanted that as 401k money as Roth, do the in-plan conversion and pay the taxes on it. And you make sense?
Yeah, I think so.
Okay. Let's see. Oh, sorry, I'm running over. I hope this isn't. We're about near the end, but okay. Irma, This is Medicare, which nobody thinks about, but this is really another tax. So IRMA is all based on what your income is. So if all you have is traditional assets, and then you get Social Security, and you're taking these huge RMDs, you could have income that pushes you. This is essentially another tax, because that's your monthly. On the right, you see those are your monthly premiums, and those look back 2 years. So when you're 63 years old, you have to start Medicare at 65. They look at your income in 63 and determine what's your IRMA, how much your monthly premium's going to be based on your income. So with a married couple, you could end up spending, this is if you're, I gave the example of if you had greater than 500K of income, or actually I guess 750K, if you're at the largest premium versus the smallest premium, for two people, that's another $10,000 you're paying a year for Medicare. So it's something to be considering is down the road is IRMA. Ultimately, it's not that big of a deal, but it also goes into converting some of that money to Roth sooner, before you get to RMD age, or taking Social Security. Okay, and Roth conversions. This is the key, and this is what you do like in your gap years. The gap years are really from the day you retire until RMDs are required, which are 72 right now. I'd also say Social Security, because you can push out Social Security, and if you can, you should in general, because you get 8% more per year for each year you delay Social Security from normal retirement age. Any year you take it before normal retirement age, which is currently 67, you lose 8% a year. So people that take Social Security at 62 are just killing themselves long term with the amount of money they're losing long term in general. But to do a Roth conversion, you take your money, you put it into the traditional IRA, and then you convert that money inside whatever tax bracket you want. That's where you have complete control of how much you're going to pay taxes on it. So let's say in the assumption that you have zero income, which is unlikely, you probably have distributions and other things. But let's say you have zero income. You could, if you're married right now, and you could contribute actually over 100,000, because the current deduction is like almost 30,000, right? The standard deduction for taxes. So you could contribute 83,500 plus. You could convert that much plus the 29,500, because that's going to come off as a deduction, and then only pay 12% taxes on that money converted from traditional to Roth IRA. Now it's in the Roth IRA, tax-free growth forever. If your income's higher, you see, but you just want to look at your tax bracket where you're at, and that'll show how much you want to convert each year. And you do that over, whatever for your gap years. Every year, do some amount of conversions to keep filling up that Roth bucket as large as you can at the lowest tax rates, and that'll also hopefully minimize your IRMA, minimize your RMD taxes. It just sets you up well. Okay, another thought: establish residency outside of California after retiring. You can save a lot in taxes right there. You go to Nevada, you go to Texas, Florida, whatever, Washington, wham, that's tax savings right there when you do these conversions. So okay, now talking about tax management over time. Don't worry, I don't mean these equal buckets is just the easiest way to drop this pie chart. But these are your three things that they can really do maximizing your best tax management throughout life is having those brokerage account where you're only paying capital gains taxes on a fraction, on your growth. You got your traditional IRA, and you do want some traditional because you don't want it all in Roth either, because otherwise you've paid too many taxes overall. And then your Roth money. But like say down the road, if you were wanting to buy buy a vacation home, you want to pay cash for it, or you want to buy an RV, some large purchase, how would you want to do that? If you pull, what's that?
brokerage account?
Brokerage account, or it could be a combination of brokerage, and you could do a little bit of each. You could do some brokerage, you could do some Roth. That way you're not paying maybe too much in capital gains. But you don't want it all from your traditional, because you pull out, let's say you pulled out 300,000 that year, you're paying income taxes. Suddenly your tax bracket is super high because you're paying taxes on 300K of income, because that's how the IRS sees it. Anything you pull out of your traditional 401k or traditional IRA is income, and you're paying income taxes on it. So you want to limit those for large. You don't want to use that for these large kind of purchases. Monthly expenses, yeah, that's what you'd use it for, but not for those large kind of purchases. Here's the thing, though. This is what too many people have is nearly everything is traditional, and so that's where those Roth conversions in the gap years come really into play. Hopefully you're not doing this when you're young, when you're in a low tax bracket. Take advantage of the Roth right now and fill up that bucket. And then as you're making even more money down the road, you can use more traditional. And by the way, all matched money by the company is always pre-tax. They get a tax deduction as well for that. Why not all Roth? Well, then you paid way too much taxes. And there's a fact of one of the things you can do with money as well, if you're charitable minded, is you can, there's a couple of great ways, but once you turn 70 and a half, you can do what's called qualified charitable distributions. You can give up to $100,000 a year to a charity. Now, if you did that with Roth money, that was a waste, because this money is tax-free. So you could take $100,000 from your traditional Roth, goes right to the charity. They don't pay taxes, you don't pay taxes. They get the maximum donation from you, and nobody pays taxes. The only person that's out of luck, Uncle Sam, because he doesn't get taxes. But that's why you should have another reason why you should have a decent amount of traditional as well. And plus, as we showed kind of before, as you're doing these Roth conversions, when your income, after you stop working and likely your income's lowered, you can convert a lot of that money at a low tax bracket, and then have it tax-free for life. Okay, power of compounding. Just to end this, a piece of paper is 0.05 millimeters thick, but if you folded it just 40 times, that's how tall it is. Think about that in terms of your money. In your 20s, the rule of 72, right? That's where whatever your rate of return is on your investments, let's say 8%, that's commonly used one. Whatever that divides into 72 is how many years it takes for your money to double. So at 8%, that would be 9 years your money would double, right? You're in your 20s, you've got about another 7 double-ins of your money. If you don't go too conservative too fast, that's a lot. That's why start now. That's why your savings rate is more important than your rate of return right now. As much as you can put away, that compounding is just going to be astronomical down the road. It seems slow initially. They say the first 100K is the hardest, and then it grows rapidly. And I've heard so many people agree to that, and it does. It grows quickly. But it seems so sluggish at first. It seems like it's taking forever, but just trust it. Compounding is the key, and equities is where you're at. Don't go too conservative. I'm not telling you how to invest, but don't go, don't go too conservative too early either. That's one thing I have with target retirement date funds. They're great initially starting because you could just throw it in and let it go. But down the road, you want to change that because they go too conservative too soon, in my opinion, typically. So you're like all bonds and not making any money. Whereas you always, even when you're 65, you want a decent portion in equities because, I expect to live till I'm 100. So 65, that's 35 years. That's a lot of growth I still want. That's so to these target retirement funds just go a little conservative. So if you have that, that's fine. But down the road, you'll want to get a little better finesse in your allocations. That makes sense. The last thing, put on Nicole. We talked about this. everybody wants to save for the kids, but you need to save for yourself first. Put on your auction mats first. You don't want to live in the basement of your kids, or in this case, and that's terrible. But it's important to take care of yourself. You need to take care of yourself first, and then as you can, help your kids out. You can, there are student loans for school, but there's no loans for retirement. So just something to think about. Okay, other topics we can explore. Any questions right now? That's what I had for today. Hopefully that you found that useful, and if you haven't taken a lot of steps, they provided you some steps to help securing your own retirement down the road. Any questions? Or anybody, and you could share these later if you have topics, specific things you want to go into, but I try to do just a deeper dive just into the retirement accounts today.
Alan, I thought this was great. Always a good refresher.
Thanks.
This is great, Alan. Thank you.
Thanks.
Will you be making the slides available?
And
Yeah,
the
for a small
recording.
fee. Just kidding.
Why
Yeah,
not?
Got a Venmo $15.
yeah, I'll send out the slide deck just like you did last time.
Sure, perfect.
Thanks, Alan.
Yep.
You also send out the recording too.
What's that?
Sure.
I can do with Lancer, and I heard Lancer's going away just today. So I can do Lancer, but it's too large of a recording to send out by email, and it won't. It's too big of a file to put it on SharePoint. And so I got it right now. Lancer is the way, because one, like I said, this isn't sanctioned. And if you guys think these are worthwhile, I'll talk to learning and development, et cetera, and see if they, we can make this authorized, I guess, by Viasat. If you guys think I might need some help from you guys. Like I said, I'm not a financial advisor, but I think, hopefully that you find this stuff helpful.
Thanks.
Okay. Thank you. And if you have any
Thanks so
questions or
much,
topics,
Alan.
yeah, you're welcome. And if there's specific topics or questions that this leads to, which I'm sure, Shama, I'll get with you after and make sure you understand that the whole pro rata stuff. But a lot of these things are confusing, and but there's tons of topics, and I'll try to go into. Sorry, I went 15 minutes over here, but try to go into, trying to go into a little deeper dive into specific topics rather than the broad brush on everything.
Thanks.
But your questions help, because I don't know what you don't know, so questions help me figure out what's useful. Okay.
All right. Thank you, Alan.
Okay.
Thanks, Alan. Take care.
Hey, Alan.
Thank you.
Let me see, what was the chat? Okay. Okay. Thanks, everyone.
Thanks, Alan.